Now, after manufacturing the product, it is expected that the product gets to the final users or the final consumers, and this is usually done by transferring the goods manufactured to the trading unit. So in the trading unit, it is expected that necessary steps are taken to ensure that the goods get to the final consumers through selling and distribution. In this class, we'll be looking at trading after manufacturing. Now, what we are trying to establish here is that after manufacturing the product, the next phase or the next step is to ensure that the goods get to the final consumers, and this is now where the trading unit step in. So here, after the manufacturing, the goods are transferred to the trading unit. So in accounting for business involved in production or manufacturing of the goods they deal in, after the manufacturing account comes a trading profit and loss account and the balance sheet. So basically, what happened is after manufacturing, goods are transferred to the trading section. So we expected to be able to identify the gross profit derived from the traded manufactured product. We expected to identify the net profit derived from the traded manufactured product. We also expected to identify the assets and liabilities of the business. So basically, after the manufacturing account, to prepare the trading account, profit and loss account, and the balance sheet. Now, here are other terminologies. In the last class, we talked about direct materials, we talked about direct labor, we talked about prime cost, we talked about work in progress. Now, in this class, we're going to be talking about some other terminologies. We have office to administrative expenses. After producing, we have the trading section that is involved with what selling and distribution. So we have other expenses called office expense or administrative expense. These expenses are not in any way related to the manufacturing of the product or factory. Here, they are related to other aspect of the business aside from production. So office administrative expenses are the cost incurred by the business in managing other aspects of the business aside from production. For instance, after production, you spend money on selling and distribution, you spend money on advertising, you spend money on commission, insurance, warehouse. So these are referred to as office and administrative expenses. So we have finished goods. Finished goods represent the manufactured product. We talk about work in progress to be unfinished product. So when the products are not completed, they are referred to as finished goods or finished product or manufactured product. So the cost associated with the finished goods or manufactured product is all referred to as the goods completed. So finished goods represent the manufactured product for the period or the completed product for the period. We can have finished goods at start or finished goods at end. Remember, it is the finished goods that are distributed or sold to the final consumers. So here is a summary of what we are talking about. This is the manufacturing business. What are the accounts? We've already established how to prepare this manufacturing account. What's the essence? To derive the cost of production or cost of manufacturing for the period. After manufacturing, we transfer it to the trading section to distribute. So what do? We're trading. So prepare trading account to get your gross profit on the traded manufactured product for the period. Then we'll prepare profit and loss account to get net profit on the traded manufactured product for the period. Then what next? We show the financial position of the business in terms of assets and liabilities. So that is shown in the balance sheet. Now this is what it looks like. We are already familiar with the manufacturing account. Now after manufacturing comes trading. Okay, so By the time you finish manufacturing, you prepare your trading profit and loss account for the year ended. So this is what it looks like. We're already used to preparing trading profit and loss account. We have a class on that. So if you are not familiar with preparation of trading profit and loss account, check out the class on our YouTube channel, Jado's Consulting. So we are already familiar with preparing trading profit and loss account and the balance sheet too. So check out that class if you're not familiar with that. So let's go. So we have trading account. We already are aware that trading profit and loss account is a function of your turnover, cost of goods sold, other income, and your total administrative expense. So we have our turnover. Turnover here is sales. It doesn't change. So we have note 1. That's our sales. What we sold, returns inward. What has been returned out of what we sold. You sell 10 million to them, they return 1 million. So your turnover is 9 million. That's what we have here. The turnover. So less cost of goods sold. So cost of goods sold is the same thing, but here remember we are manufacturing what we produce, what we are selling. So we manufactured it. So we have opening stock of finished goods. That's goods manufactured in the last end of the last year or the beginning of the current year. So you add the ones that you finished producing for the year. So this is cost of goods completed for the year. Then you less the closing stock of finished goods at the end of the year. That will give us our cost of goods sold. The next one is other income. Yeah, note 3. It can be discount received or any other income received in the period. So we have other income. So basically our gross profit is note 1 minus note 2, which is turnover minus cost of goods sold. So you have gross profit. So you add your other income. If you add your other income to your gross, if you have gross income here, then you now less your total administrative expense. So here are your total administrative expense. You have office rent, warehouse expense, office salaries, office. You can see that no expense here is related to factory. Okay, so in your question, even if it is marbled up, you should be able to differentiate from factory expense and office expense. So your factory expenses goes to your manufacturing account, your office expenses come to your trading profit and loss account. Because in some questions they might tell you that you should apportion, maybe they can tell you apportion wages to maybe 10% factory, 90% office. They can tell you to apportion insurance to 10% factory, 20% office. So you should be able to share it among factory and office. So basically whatever is meant for factory goes to the manufacturing account, whatever is meant for the office or administrative expense goes to the profit and loss account. So let's understand that fact. So here all your administrative costs have to be expenses related to office, selling and distribution. Factory expense does not come here. It goes to your manufacturing account. I've already explained that. So when you put all your expense together, the total is what you have as total administrative expense. So if you take out your admin expense from your gross income, you have your net profit or loss. Your net profit here is your gross income minus total administrative expense. If your total admin expense is higher than your gross income, then you have a loss. But if it is less than your gross income, you have a profit. So here we're looking at statement of financial position. I've already explained that statement of financial position is your balance sheet. We are already familiar with the preparation of the balance sheet. There's a class on balance sheet already. Trading profit and loss account and balance sheet. Go back to that class and familiarize yourself with it. Okay, if you're not familiar with balance sheet, go to that class and get used to it. So basically, what's the balance sheet? You're showing the asset of the business, which has to do with the resources that the business has, against the liabilities, which is what the business is owing. So what do you have? You have your assets here. Net current assets. These are your fixed assets. Note 5. You can see them here. Net current assets. Okay, you can see your net current assets here. Your net current assets, net depreciation. So whatever amount depreciated, you have to take it out here for you to get the value that will come here. Then we have other assets, goodwill, patent and other rights. I already explained. Less amortization, that's what you're writing off every year. That's what you have here. Current assets, you have your current assets here, note 7. Cash at bank, cash in hand, debtors, closing stock of raw materials, work in progress, finished goods, all those items to come here. That's make up your current asset. So when you add your 5, 6, 7 together as your not current asset, other asset, and current assets, or you can say net current assets plus other assets to give you this. Current asset is this. When you bring that here, when you add this to this, you get this. So basically, when you add 5, 6, and 7, you get this. This is your total assets. So the next one is your liabilities. We have long-term liabilities. Okay, bank loan and other long-term loans and obligations, because you can have arrangements to get other loans, not necessarily from the bank. Okay, so you have a long-term loan, bank loan, other loan, long-term obligation. When you add together, you have a long-term loan. Short-term liabilities, you can see them here: bank overdraft, creditors, and other short-term obligations. Basically, long-term loan or long-term liabilities are liabilities that will take over a year to pay. Short-term takes less, just a year basically to pay, or less than basically 12 months to sort out. That's short-term liabilities, so, or current liabilities. So we bring them together here. You have this. So when you add your 8 and 9, which is your long-term liabilities to your short-term liabilities, you have this. Owner's equity. I told you owner's equity is the capital of the what? Business. Okay. So we have the owner's equity here, note 10. That's your capital plus your profit. Remember, if you invest into a business, the business is able to yield profit. So when it yields profit, okay, what happens? It will increase your investment in the business. So capital can increase or decrease. So when you have profit, your capital will increase. When you have losses, your capital will decrease. So you have your capital plus your profit. And then you can have drawings. Okay, maybe the owner took some business or money for himself, or took some product for himself. So sometimes we call it director's current account. Basically, your capital plus your profit and your drawings or director's current account is manipulated to get your what? Owner's what? Equity. Okay, capital is what you use in starting the business. So basically, if you make profit, it will increase the capital. If you make loss, it will reduce the capital. So when time you look at your owner's equity, if you add your owner's equity, so basically if you add your what? Owner's equity to your what? Long-term liability and short-term liability, you have your total liabilities. Okay, so basically your 8, 9, 10 gives you this. 5, 6, 7 gives you this. So at the end of the day, your total asset must be equal to your total liabilities. So here is an illustration preparing trading profit and loss account and balance sheet after manufacturing. Okay, it's an improvement on the question we solved in the manufacturing class. Okay, so you should go there to understand how cost of goods manufactured is derived, because that is basically the essence of the manufacturing account. Okay, so in this class they said from the following you are to prepare trading profit and loss account and balance sheet as at 31st December 2018. So here are the questions. You can see sales, land, cost of goods manufactured 1,308,000. Remember, your cost of goods manufactured is derived from your manufacturing account. So in this question, basically, they have already prepared the what? Manufacturing account. They're just giving us the cost of goods manufactured. But in some scenarios, you'll be asked to prepare the manufacturing account, prepare the trading account, prepare the profit and loss account, and the balance sheet. So basically, it's the same thing. Okay? But here, they've already helped to prepare the manufacturing account. So this is the cost of goods manufactured. This is what you derive from what? Manufacturing account. So basically, let's proceed. We have returns inward, factory plant, office rent, warehouse expense, okay, motor vehicle, equipment, bank loan, bank overdraft. Okay, what else? We have office salaries, capital, office van repairs, discount received, discount allowed, opening stock of finished goods, debtors. Then we now have cash at bank. You can see it's a trial balance. It has agreed here. Then we now have additional information. Closing stock of finished goods 80,000. Depreciate motor vehicle by 25%. Accrued office rent at 31st December 2018 is 30,000. Prepaid van repair at 31st December 2018 is 10,000. Okay, and remember, we already know how to treat accruals and prepayments. If you don't know it, go to our class on what? On accruals and prepayments. I explained there how to treat accruals and prepayments. So is that knowledge we're using here now to treat accruals and prepayments in this class. So basically, let's go. Let's prepare the trading profit and loss account. Here we have the trading profit and loss account for the year ended November 2018. We already know that our trading profit and loss account is a function of what? Turnover, cost of goods sold, other income, and total expense. Okay, so let's go. Turnover here, note 1 is 2,305,000. How did we get it? Look at note 1 here. Sales 2,455,000. Here is the sales here. Look at the question. 2,455,000. So we have returns inward 150,000. Remember, if you sell and it returns on back to you, it reduces what you sold. So 2,455,000 minus 150,000 give us 2,305,000. So these are our return inward from the question, 150,000. So if you take it out, you have turnover of 2,305,000. Okay. The next one is your cost of goods sold. That's note 2. Look at your cost of goods sold, note 2. Remember, we are selling what we manufactured. So it's a function of your opening stock, which is your finished goods, 430,000. It's in the question. What do you have there? Opening stock of finished goods. Where is it? Okay, here it is. Opening stock of finished goods, 430,000. That's what you have here. Then we now have cost of goods manufactured. That's the cost of goods that you produced for the period. So basically, if it was not given to us in the question, we will be asked to prepare it, the manufacturing account. So the cost that we derive in the manufacturing account as cost of production is what we're bringing here as 1,308,000. So you add it to your opening stock, you have this cost of goods available for sale. Take out your closing stock of finished goods, 80,000. It's in the question. Can you see closing stock here? 80,000. So you minus 80,000 from this, you have 1,658,000. That is what you have as your cost of goods sold here. So take out your cost of goods sold from your turnover, you have your gross profit. Okay. Now, other income, note 3. What are the makeup of other income? Look at other income, note 3 here. Discount received. That's about the only thing. So what's the discount received here in the question? You can see 145,000. If the question gives you any other income, please take it to other income. Okay. So that's your 145,000 you have here. Add your 145,000 to your 647,000. You have your gross income, 792,000. Okay. So what you now do? You less your total what? Administrative expense. That's note 4. Here, note 4. Here is our total administrative expense. So we have office rent. What's our office rent in the question? 98,000. But there's an additional information on it. Accrued office rent as at November 2018 is 30,000. Remember, accruals at the end of the period is added. Okay? At the beginning of the period, you deduct. So basically, this is at the end of the reporting period. What do? You add. That's what we're doing here. Office rent 98,000 plus 30,000. That gives us 128,000. Remember, the accruals at the end of the period, after adding to the expense for the period, is reported as what? As a current liability. Okay. What are accrued expenses? Expenses that you have incurred but you have not yet paid. So basically, you are owing the creditor. So we have office rent 98,000 plus 30,000. That's 128,000. Warehouse expense 125,000. What's the warehouse expense here? 125,000. Is there additional information? No. So the next one is office salaries, 250,000. Where's office salaries here? Look at 250,000. Any additional information? No. So office salaries is there. The next one is depreciation of motor vehicle, 81. What did they say? Depreciate motor vehicle by 25%. Okay. So what's motor vehicle in the question? Motor vehicle in the question is 325,000. So 0.25 of 325,000. You can do that with your calculator. Or 25% of 325,000 is 81,250. That's what you have here. And remember, after depreciating it in the expense account, you have to take it out of the motor vehicle in the balance sheet. The next one is van repair. Van repair is how much? Where's van repair? I can see van repair here. Okay, look at it. Office van repair 70,000. Okay, now there's an additional information. Say prepaid van repair as at December 2018 is what? 10,000. Remember, in our prepayment class, prepaid expenses at the end of the period is what? Is deducted. Okay, and I told you when you prepay an expense, that means you have an asset because the person you paid in advance is owing you. Okay, so there's a class already on prepayment and there's a class on accruals. You can go back to that class on our YouTube channel, Jadu's Consulting, to refresh your memory on what's prepayment and what's accrual. So basically, van repairs 70,000 minus 10,000. That gives you what? 60,000. So the next one is discount allowed 55,000. Discount allowed is here, 55,000. When you add all together, you have 699,250. That's what you have here as total expense. Note 4, 699,250. So when you take out 699,250 from 792, you have 92,750. That's your net worth profit. So the next one is your statement of financial position, which is also your balance sheet. What does your balance sheet show? It shows your assets and your liabilities. So let's go. What are the assets? The first one is net current asset, also called your what? Sorry, non-current asset, also called your fixed asset. Note 5. So we have note 5 here, non-current asset. What are they? Land and building, 2,240,000. It's in the question. Look at it. Land and building, 2,240,000. The next one is motor vehicle, 243,750. What is your motor vehicle here? 325,000. Remember, we depreciated it, okay, by what? 25%. So what was the value of depreciation? Look at it here. Depreciation of motor vehicle, 81,250. So if you take out 81,250 from 325,000, you have 243,750. Okay. So let's go. Factory plant, 765,000. That's in the question. 765,000. Office equipment, 550,000. Is in the question. 550,000. So when you add all together, you have 3,798,750. Okay? This is what we brought here as your non-current asset. So we have other assets, but there's no other asset in the question. But if you had, just recognize it there. Goodwill, patent right, copyright, and other non-fixed asset items or non-current asset items at the same time. Like these assets that are not physical, or it can be fictitious as well, so long as it is recognized as an asset, okay, but not fixed or current, it's other assets. So in this question, there's no other assets, so that's why you have dash here. The next one, we have current assets. Note 7. Look at the current asset items here. Cash at hand, 645. It's in the question. Where do you have it? Cash at bank. Okay. So we have cash at bank, 645,000. It's in the question. Look at it, 645,000. The next one, we have debtor, 655,000. Where is it? Debtor, 655,000. Prepaid van. I told you when you prepay, you understand? That means the person you paid in advance is owing you. That's an asset. Debtors are asset. That's why you have it here. Then closing stock of what? Finished goods, 80,000. If the question gave you, question that will make you prepare your manufacturing accounts, you would have seen closing stock of work in progress, closing stock of what? Raw materials. They will also be form part of what? Current asset. But in this question, the only one here is finished goods. So we have closing stock of finished goods at 80,000. When you add all together, 1,390,000. That's what you have here. Current asset, 1,390,000. So when you add 5, 6, and 7, or better say, if you add 5 and 6, you have 3,798,750. You bring 7 down here, 1,390,000. When you add 1,390 to what? 3,798,750. You have 5,188,750. That's your total what? Asset. So the next one, let's go liabilities. What are the long-term liabilities there? Bank loan is the only one in question here. Where's the bank loan? You can see bank loan here, 1,600,000. That's bank loan, 1,700,000. The next one here, you can see long-term liabilities, 1,700,000. The next one is short-term liabilities, note 9. What are they? You have accrued office rent. Remember, accrued expenses are what? Liabilities. So they are here, 30,000. Then we have bank overdraft, 120,000 in the question. When you add together, you have 150,000. Here's the bank overdraft here, 120,000. Accrued office rent here, look at it. So we have 150,000, note 9, 150,000. This is how we got it, 30,000 plus 120,000, 150,000. The next one is owner's equity. I already explained that your owner's equity is a function of your capital, profit, and drawings or director's current account. So what's your capital? 3,346,000. That's in the question. This is your capital. Look at it, 3,346,000. Then your profits based on the question or based on the profit and loss account is what? 92,750. That's what you have here. If you add it together, there's no drawings, so there's no accounts. You have 343,8750. So we have owner's equity 343,8750. So when you add long-term liabilities plus short-term liabilities 8 and 9 together, you have this. to give you 1,750,000. Then bring down your owner's equity 343,850. When you add 343,750 to 1,750, you have 518,850 total liabilities, and this is equal to your total what? Assets. So this shows your statement of financial position. In this class, we've been able to prepare the trading profit and loss account and balance sheet after preparing the manufacturing account. The manufacturing account is basically to derive your cost of goods manufactured, okay? And then there's a cost of goods manufactured that you transfer to your trading account, okay? And then you prepare your profit and loss account and prepare your balance sheet. Do you understand? So in this class, we're also able to look at accrued expenses and prepaid expenses, okay, that we've done in some other class. You can check out the class on accruals and prepayments on the YouTube channel. We also touch depreciation. You can as well check, there's a class on depreciation as well. You can check that out as well on the YouTube channel. So if you have questions, you can reach me on 08136506356 or send me an email, jeremiah.dusu@gmail.com. You can drop questions in the comment section. I'll be there to reply you with the right answer. And don't forget, no matter how the question appears, just find a way to interpret it properly. You will know how to treat them, no matter how voluminous it might appear to be. It's the same concept if you have gone through what I have taught you properly. Thank you.